Let's talk revenue recognition under International Financial Reporting Standards. There is a 5-step process. Ready? Step 1. Identify the contract with the client or customer. This is your starting point. Both parties should know what their obligations are. Step 2. Identify the performance obligations in the contract. What are you promising to deliver? Each distinct good or service promised to the customer counts. Break them down. Step 3. Determine the transaction price. This is the amount you expect to be entitled to in exchange for providing goods or services. Are there other considerations like discounts or rebates? Make sure you take those into account too. Step 4. Allocate the transaction price to the performance obligations in the contract. If there is more than one performance obligation, you need to allocate the amount to each performance obligation. For example, a product with an additionally purchased warranty. Allocate the price to the product being taken today and the warranty being provided over the next year. Step 5. Recognize revenue when or as the company satisfies a performance obligation. Recognize revenue when control of the goods or services passes to the customer. This could be over time or at a single point in time, depending on the nature of the obligation. Many times, revenue recognition is simple, when someone provides a good or service. Other times, it may require more analysis to determine when to recognize revenue. The goal is to record revenue when a company is supposed to, not before or after. IFRS revenue recognition, a 5-step process. Identify the contract. Nail down those performance obligations. Figure out your transaction price, allocate it accordingly, and finally recognize that revenue. It's all about understanding and applying these steps methodically.